All right, well, let's get started. Welcome, welcome. Welcome to Marshall Reddick Financing for 2024. You guys ready? It's going to be an exciting time with us. We have a really special guest, Reed Hazard. He is definitely the oracle for this year. He has very specialized skills and has been right predicting what's been happening with the market for the last few years since COVID. So let's get started with the slides. Hopefully everyone can hear me okay. Who am I? I'm Danisa. Nice to meet you. Danisa Peralta. I've been licensed since 2003, so been doing that for a little while, been wearing different hats. As you can see, I've been a landlord. I'm still a landlord. I help people buy property. I help people sell property. Wore the flipping hat for a little while as well. And also now helping other clients that are more passive investors investing in our mortgage fund here at Marshall Reddick, and those that want to invest in multifamily syndications. Once upon a time, a few years ago, I also attended the business school at Berkeley, which was a great experience. It was like a dichotomy between a lot of liberals and a lot of conservatives, and it was definitely really exciting. All right, so that's a little bit about me. Well, who is Marshall Reddick? If you guys have not heard of us before, we are the one-stop shop. We're a real estate brokerage. We also have in-house property management. We lend private money to flippers, and we also help investors invest passively in our investment fund. So there's a lot of exciting things going on here at Marshall Reddick. Initially though, back in 1989, once upon a time, Dr. Reddick himself opened up his brokerage to educate the community. And since then, we've been holding a lot of webinars for free, even seminars in person. So definitely keep on checking the events tab on our website to come and learn, so that then eventually you can apply and have someone like me, a real estate advisor, help you, guide you along the way to expand your real estate portfolio and or those passive investments. And that is who we are. So where are we? We're actually all across the US, specifically in these areas as the map indicates: the Bay Area, Los Angeles, Orange County, Riverside County. We pretty much cover all of California. As we get into the Midwest area, we're in Texas, covering all of Texas. As you know, it's a pretty big area. Nashville, Clarksville, Tennessee, and then also in Florida, specifically in Cape Coral. So there are reasons why we selected those areas to help our investors specifically gain some cash flow and also some appreciation. And of course, we're going to have our guest of honor today explain what's going on in those areas, because he's licensed across the US as well on the financing side. So a lot of my clients ask me, well, you know, how do I know where to invest? And we take a look at very specific markers and analytics. Specifically, is the job market growing in that area? Are big companies like the Walmarts of the world, the big medical companies, the big technical companies, the Amazons of the world, are they moving into those areas? Those are very important indicators of where the market is going to grow, and there's going to be a great and strong path of progress. Obviously, when we're also in that market, we don't want to see a high vacancy rate. We want to see economic diversity, affordability within housing. Is it a landlord-friendly state? We all know California is not so much so, and that's why we do guide our investors to go out of the state to those landlord-friendly states like Texas, Tennessee, and Florida. So again, like we said, you know, we provide strong education to support where we're guiding you. Specifically, we offer free information on our website, marshallreddick.com, that'll give you very specific market reports and analytics specific to that market. Now, we couldn't do this if we didn't have a reliable property management company. So it's almost like if you can think of it as armchair investing. All you have to do is relax in your chair, and then we do all the work for you. So without further ado, I want to introduce a little bit about Reed and have him come on the call and talk a little bit about what his expertise is, how he can help you, guide you, and of course, all the juicy stuff that is going on in the market right now. Reed is helping us with all our clients. I think he's helped us help over 1,000 clients by now, get them financing for their for the right fit as far as what they're investing in. So without further ado, I want to invite Reed up to the webinar.
Awesome. Thank you, Denisa. And it's so nice to be here with you guys. I've been a partner of Marshall Reddick since 2005. And so just love the company, love where it's going. I use all their services as well, which is something that I do religiously. Denisa, it looks like you need to click on that again. There we go. So, I'm also using all their services as well. So I invest in the mortgage fund. I have properties that are managed both here in Orange County and then out of state in San Antonio and in Austin. So really definitely a believer in what they do. And I love the philosophy of Marshall Reddick, the buy and hold philosophy. It's worked wonders for me. It's not a get rich quick scheme. It's a get rich right program. So I love it. And I'm here today to really talk about financing, what's going on with interest rates, and, to kind of give an idea of where they're heading this year on more of a micro level. We hear a lot of information in the news. And so I really want to kind of break some of that stuff down and then also talk about some of the loan programs that are available currently in the market. Denisa, can you hit that next slide for me? There we go. So when you're asking why CMG, that's the bank that I work for. Really quite a few reasons. We're licensed in all 50 states. We specialize in primary residence and investment property financing. We're also the largest private bank in the nation. So we have one owner, and that gives us a lot of flexibility to navigate the markets. We also have special financing available. So you guys may see out in the communities, some of the communities in Texas and Tennessee and really nationwide, that there's builders that are offering interest rates that don't tend to exist. You may see a rate of 4.75 or 5.25 and maybe wonder how they're doing that. So we do what's called forward commitment financing, where we're working with builders and different investment groups like Marshall Reddick to help them obtain financing with interest rates that is below market, where we can offer that financing to our investors. So if you want to learn more about that, you just contact me after the call or contact Denisa and she can set up a call with us and we can show you the specific properties that have that financing attached. Denisa, next slide. So one of the programs that we also offer that's pretty awesome is our rate rebound program. So anybody that's looking to do a refinance in the next 5 years, we believe that rates are definitely going to come back down. It's going to take time. I don't expect you're going to see rates in the 4% range for a really long time, if not ever. But I do believe that the natural interest rate for a 30-year fix will probably come down into the 5% range again, maybe even sooner than we expect. So my company put together a program called Rate Rebound. And any point in the next 5 years, we'll pay your lender fees, we pay your appraisal, and we give you $1,000 of credit towards your third-party title and escrow fees, which is pretty awesome. So some of you guys that are looking maybe to buy a property now and are going to maybe take a higher interest rate and pay less mortgage fees to get that deal and are maybe banking on doing a refinance, this program works out great. Some of you that may want to do a rate buy down today to hedge yourself against the market and get a lower interest rate, you'll still have 5 years on this program to help you get this refinance when the rates do come down to where it'll make sense to do a refi. So awesome program. There's really no gimmicks to this. It's pretty simple. It's anytime over the next 5 years, and there's a list of fees that we do cover, and it pretty much will get you close to a no-cost refinance in any of the markets that Marshall Reddick is doing business in. So some of the information that I'm going to be covering tonight: getting pre-approved, what does that consist of? Best loan programs available for a primary residence or an investment property. Some of the ways that we're getting creative in this market. I already touched on the builder commitment financing, so I'll touch on a few other ways that we're getting creative. Private financing options. So for any of you guys that can't qualify for a conventional mortgage, we'll go over some private financing options that are offered through Marshall Reddick. And then I'm going to give you guys a market update to discuss what's going on with interest rates and try to do a little bit of forecasting. Nobody knows what's going to happen, for a fact, but I do read the markets pretty well, and so I'll give you guys an update on what I think is going to happen this year. So getting pre-approved, the first steps when you're prepared to go and buy a home now. Let's say you want to buy a property in the next 3 months. You're ready to go. You have your money set aside, and you want to go and deploy that into a property. You'll want to get fully pre-approved. If you're not sure that you want to buy yet, you're feeling things out, but you're interested, we can do a pre-qualification really over the phone. We don't need to run your credit yet. We can just discuss your finances, and I can help to give you an idea of if you'll qualify, and then you can start building a game plan, and we can run the credit and get you fully pre-approved when you're a little bit closer to buying. Some of you may be looking at maybe buying a year from now because you're going to have a big bonus at work, or there's so many reasons why you may not be ready to buy yet, but you want to learn about how to qualify. That's a pre-qualification, and we can do that together over the phone on a consultation together. But if you want to get started to buy something now and you're serious, you want to get fully pre-approved. It's become a lot easier over the past few years. I know this looks like a lot of steps, but really we just get your loan application through readhazard.com. We'll get some pay stubs and W-2s. If you're self-employed, we'll have to get tax returns. So depending on your type of employment and your type of income, we may need to get more documents. If you're W-2 with simple assets, it's very easy nowadays to get pre-approved. And then I run the loan through my actual underwriter who will review the file and put a stamp on it. Why this is powerful, let's say you're shopping in Orange County. The average closing turn time here, there's a lot of all cash buyers. It's probably 21 days, right, to get a loan done and to be aggressive. We can close a deal in 15 days if we have you fully pre-approved. So you can look almost as good as an all cash offer when you get fully underwritten approved. Also, if you're buying out of state, the average closing turn time in Texas is probably 30 days. We can do a 21-day out of state, no problem, or even 18 days if we need to. I don't usually advise buying with a turn time below that, especially when you're buying an investment property. You want to get a home inspection. You want to have some time to review the property. So 18 days is usually about the fastest that we will advise going. But in some cases, especially for some of you guys that are seasoned investors, you guys know what you're doing there. And if we need to close in 15 days, we can make it happen. So this really gets you prepared. And then we go over loan pricing based on your credit scores and your qualifying parameters after we have you guys pre-approved. So getting pre-approved the right way, it's just simple. I mean, if you guys really want to get, let's say that you're going to sell a property and do a 1031 exchange, or, you guys are really trying to put together a game plan for how to build your rental portfolio you already have or buy your first property. Again, it's just important to get approved too, so you understand what's your max qualifying power, what are current interest rates, what are the options available to you. And then from that point, you can go out there with Denisa and she'll introduce you to the different realtors that we have in our Marshall Reddick market. So again, it really is a science here. We get you pre-approved. Denisa will do another consultation with you and get you to the right realtor in the right markets that you're looking in. And then I work with these realtors constantly. I have a great team of people as well that on the weekends, if I'm not available, somebody's available to write an updated approval letter and send it to the realtor so that we're placing an offer with the address, the offer price, very specific to that transaction. There's a way that we do things here so that we really look organized. So part of that is my team. We're going to go to the next slide. And you'll see this is my sales team. There's quite a few other people on the back end of your loan that help to make the process smooth. But these are the people that you're going to be talking to most commonly throughout the process is myself, Brian Kane, and then Mike Lynch down there on the bottom. You'll also speak with Jessica Yinger. She's my loan assistant, and she takes over the process after you're actually in escrow on a deal. When you're getting pre-approved, it's Reed, Brian, and Mike. And so it's a well-oiled machine. My business partner, Al Rodriguez, he does a lot of outside sales locally here in Orange County, but he's also fluent in Spanish. And so he does assist on some transactions through Marshall Reddick. Also, my loan officer, David Self. David is licensed in more markets than I'm licensed in. I'm in about 22 markets. David's in over 30. So my company's in all 50 states. We can cover a transaction in any state in the United States. And David himself in my branch is licensed in most of those markets. So again, just reach out to me if you have a transaction going. We really do advise the Marshall Reddick markets. I think that they're the best markets in the US to be in. Again, there are other markets though that can make sense. That you may already own property or want to refinance a property, maybe to cash out and buy a property in one of our markets. You may have bought a property in a market that hadn't done so well, and then COVID hit, and now there's been a lot of spreading of the society. Maybe people are working from remotely now, and now a certain market that you own property that you haven't seen a lot of growth, but now COVID, which again is very unfortunate COVID happened, but COVID did happen, and now the population has grown there, the sales prices have gone up, and you can sell that property for a profit and 1031 exchange it and take that equity and put it into a Marshall Reddick market. So we are all over the country. It's very important to note that. And myself and David spearhead being available in most of the markets in the US. So some of the commonly asked questions: how long is the approval good for? It's good for 4 months. So we only run credit one time. And if you don't find a property within 4 months, we won't run it again until you're ready to actually place an offer. Then we'll rerun the credit at that point. But it's good though for 4 months. The process to get approved takes 24 to 48 hours. If you have 9 investment properties or 10 investment properties, or a more complicated loan file, it can take a couple more days to get that done. But we're very quick, and I'm fully staffed to be able to move quickly on complex transactions. So after you guys get pre-approved, some of the things that we definitely want to do while we're out there looking for a new property is we want to stay at our current job. If you're going to go from a W-2 job to another W-2 job, and it's in the same line of work, and you're pre-approved, but hey, you got to take the new job, that's okay. We could still use that new income. We'll just document your offer letter, and you actually don't even need a full 30 days of pay stubs at the new job in order to close. An offer letter without any real contingencies in that offer will work fine. If you go W-2 though to being 1099, even if you have, even if you're, let's say, a doctor, and you opened up your own practice after you got pre-approved and you thought it was going to be okay to use that new income right away, you have to be self-employed 1099 at that point for 2 years before we can use that income. So any of you that are thinking of going W-2 to 1099, just know that it will take you out of the game for being able to get a conventional mortgage for at least 2 years. Another thing you want to do is keep all your current existing credit cards and other accounts you have on your credit. Keep those open. Don't cancel any accounts after we have you approved. It could actually adversely affect your credit. And if you want to close something down, just call your loan officer, call us, ask us. Just double check with things like that. If you want to buy a new car, just check in with your loan officer. When we qualify you, it's based on a debt to income ratio, and your ratios might be very tight for the property you're trying to buy. And now you go get a car that had an extra payment of $500 a month, and then you get into contract, and now your debt ratios are above a certain level, you can't qualify. So just again, after you get pre-approved, try not to make any big purchases unless you talk to your loan officer, and always stay current on all of your financial accounts. You never want to go late. And obviously this is a fact everybody knows, but you really don't want to go late on a mortgage or on a credit card. Just super important to keep your credit in the highest standing possible as you build a portfolio of real estate. You may want to do a refinance in the future also and need to access your credit. You might even be done buying property, but it's just so important to keep those credit scores high for so many reasons, right? To be able to do another loan in the future if you need to. So again, always stay current on those existing accounts. And then things not to do, I already covered on most of these, but one other note that I will make is any money that you're going to use to buy this property needs to be seasoned in your bank account. In lending, we ask for 2 most recent bank statements for the account that you're going to use for down payment. So if you're looking at getting some money from family, or if there's some money that you want to put in your account that you don't want to have to explain where it came from, that money needs to be in the account for 2 full months with 2 bank statements, not showing that initial large deposit. Otherwise, we've got to find out where it came from. If you're selling stock from one account and moving it into the other, that's totally fine. We can source that you sold stock in this Charles Schwab account and moved money into your, whatever, Bank of America checking account, and now it's been sourced and seasoned. But again, we'll always ask for 2 most recent bank statements. So if you put money in your account in January and then you get your March and April bank statement, don't show any large deposits, then that money is considered seasoned, and now you can use it to go buy an investment property or buy a primary residence. There's no gift funds allowed when you buy an investment property. There is if you buy a primary home, but not on an investment property. So how do we qualify you? I always like to cover this slide. This is really the fundamental basis of how we qualify you for a mortgage. Everybody on this call has a debt to income ratio. And the math for a debt to income ratio is if you make, let's say, $10,000 a month in W-2 income, let's just say your salary is $120,000 a year. And let's say the home that you live in with principal and interest on your loan, property taxes, homeowners insurance, whatever those monthly fixed expenses are, let's say that's $4,000 a month. And let's say you have no credit card payments, you pay them off every month, but you have an auto loan of $500 a month. That's $4,500. $4,500 divided into 10,000 would be a 45% debt to income ratio. For these types of loans, you can't go above 50% debt to income ratio. When you're buying an investment property, we know you're going to rent it out. So let's say it rents for $1,000 a month. We can take 75% of that projected rental income, if it's not already leased, which many of them are not. Some are, most aren't. We could take 75% of that amount and add that onto your income towards qualifying. So now if your mortgage payment, let's say, is $750 a month, and we can take $750 a month of projected rent and add it onto your income towards qualifying, your debt to income ratio will be the same. That property will debt service itself. So some of you that already think you have a high debt to income ratio, again, buying investment property, you can use projected rents to offset the DTI, which is really cool. And so we have clients that have built a portfolio of 10 investment properties over the years, some that don't have a very high income, and they're very great savers. And they've been able to even leverage their properties and pull cash out at certain times and use that money to buy another property. And again, because they're claiming all their rental income every year on their taxes, on their Schedule E, they're able to continue qualifying. So that's how debt to income ratio works from a lending standpoint. And debts that are not included in your DTI are auto or health insurance, cell phone, utilities. I put on here loans to family and friends that are not recorded, business loans. If you can show that a loan is tied to your business, that the business pays for it, and that it's documented that way on your tax returns, we can omit or take that out of your debt to income ratios. So I want to cover conventional loan programs first. Conventional loans are the lowest interest rates with the lowest down payment requirement for buying a primary residence or an investment property. So the loan limit in Orange County, if you can believe it, has now gone to 1.15 million. On the update that I did back in September before they issued the new loan limits, I was thinking that loan limits would probably go to somewhere around 1.13 million. Loan limits tend to go up with wage inflation and based on home price appreciation. And I'm going to show my next slide here in just a second, not yet, but in a few seconds. I'm going to show a history of the conventional loan limits. What is conventional? What is Fannie Mae and Freddie Mac? Fannie Mae and Freddie Mac are the largest purchasers of mortgages that are fully documented. So documenting your income, documenting your assets, documenting your credit. For doing that, you get the lowest rates, lowest down payments. And those companies, Fannie Mae and Freddie Mac, they provide liquidity by purchasing mortgages from big banks, small banks, medium-sized banks that originate these loans for the public. They then sell those loans to Fannie Mae or Freddie Mac or to other institutions and hedge funds, but they've been underwritten with the ability to be sold to Fannie Mae and Freddie Mac, making them a conventional mortgage, okay? And when you're looking at a conventional mortgage, it's the most accessible capital in the United States. Most loans that are done in the United States are done conventionally. And Fannie Mae and Freddie Mac were essentially bought out by the government. The government bailed out Fannie Mae and Freddie Mac back in 2009 when they bailed out all the banks through the TARP funds. They bailed out quite a few banks. And Fannie Mae and Freddie Mac, they were nationalized by the government. So really the government is driving the ship with Fannie Mae and Freddie Mac. And why it's significant is if Fannie Mae and Freddie Mac are raising their loan limits, it means that they believe there is wage inflation in the economy. It means that they believe that people are going to need to continue qualifying for these mortgages and have the ability to, and we're in a strong jobs market. And they're the ones holding most of the Fannie Mae and Freddie Mac debt, right? So if they're raising their loan limits, it's always a good sign for the economy and for home price appreciation. One other thing I want to note is on a conventional loan for a primary residence, you can go with as little as 3% down. And recently, they finally will allow you to put as little as 5% down on a 2, 3, or 4 unit property when you're going to live in it. When you're buying as an investment, it requires 25% down. But you actually can buy a duplex now, for example, with 5% down on a conventional loan. You could buy a fourplex, 4 units, live in one of the units, and get it with as little as 5% down. That's never happened, and it happened last November. So pretty awesome update to conventional guidelines. The total debt to income ratio requirements allowed are based on FICO score. So this slide just shows you, obviously, the higher the FICO score, you'll be able to max out your debt to income ratios on a conventional loan. And on conventional, like I said, it maxes out at close to 50%. So here was the loan limits for 2023. On the left side, you'll see that the 1 unit is $726,200. And on the right side, on the top, is for a 1 unit. It was $1,089,000. You can go as little as 5% down if it's a high cost loan limit area. Let me break that down real quick. Nationally, the loan limit is $726,200 in 2023. That's nationally. In high cost markets like Orange County, Los Angeles, the Bay Area, there are high cost loan limits where Fannie Mae and Freddie Mac will buy mortgages to a higher loan amount above that $726,200 when it was 2023. When you go at the high balance loan on a primary residence, you can go as little as 5% down. These are the new loan limits. As you can see here, they've raised those to 726. Sorry, I'm having trouble with my slide here. There we go. So as you can see here, they raised the loan limits from 726 all the way to 766,550. So they actually raised these 5.5% in 2024. Reason being, conventional wage inflation was about 4%, and then home price appreciation was close to 6%. And sure enough, Fannie Mae loan limits have gone up 5.5%. Why this is so significant is, you guys, you can get a primary residence in Orange County now for, call it, $1.25 million and put 5% down and get a conventional loan. That's very significant. What do you think happened to homes that were $1 million the end of last year, when now these loan limits have gone up another, $100,000 or $75,000? Those values have gone up because now more people can buy that property. And we already are dealing with very, very low inventory. So the loan limits, again, have a lot to do with home price appreciation. And if you look here, I've highlighted all 4 of these. you can get a 4-unit property. Let's say you had a duplex in Los Angeles. I mean, you can get, you know, a 4-unit, a $2.75 million 4-unit, and finance $2.2 million on a conventional mortgage with great interest rates. So again, those loan limits are very, they're very amazing that the government has raised them this much, and it just goes to show how much strength there is in the economy for the government to be willing to continue raising loan limits like this. It's just fascinating. So this next slide really takes us back. It's going to take us back to 2006. So in 2005, the loan limits were around 363,000. It was the last time that Fannie Mae and Freddie Mac raised their loan limits. Now, they weren't owned by the government back then, but they were a very monitored institution, at least to an extent, right? They were buying most of the conventional loans back then. And so what you noticed was in 2004 and 5, we did have some good wage inflation. The dot-com bust had happened, but then there was a lot of jobs that were created off of it and a lot of appreciation in the economy through 2004 and 5. And in 2006, they stopped raising that loan limit. There was a lot of speculative lending going on. And we all know what happened in 2008 and 9. You know, there were the pick-a-pay loans, which were one of the things that contributed to the economy crashing. People in 2006 and 7 were getting stated income loans. They were stating their income. They weren't verifying it. They were stating their assets. They weren't having to verify it. And they were buying with 0 down payment. And not only that, they were buying with these loans where if the rate was 6 or 7%, they were picking to pay only 1% of that. You could pay 1% of your interest. You could pay the full interest only payment, or you could pay the principal and interest payment. But that 1% payment option was only available usually for 12 or even 24 months. After that, the loan you'd have to pay principal and interest moving forward. And so people were buying and buying with the idea that home prices are going to keep on going up, and I'm going to buy and pay the minimum interest. And that other 5 or 6% that they were not paying was going on top of their loan balance each month. And then when home price appreciation stopped going up, people were upside down on their homes. Then they had to start paying the fully amortized payment, principal and interest. They couldn't sell the property, and they couldn't make the payment. Then the jobs market also fell apart because the value of companies in the stock market went so far down. And we went through this period where people were losing their homes or having to short sale or foreclosing. And so there was very little wage inflation in the economy for a decade. Unemployment actually hit 10% in 2010. Okay. And from that point, all these foreclosures and short sales in the market slowly started to get bought up. Fannie Mae and Freddie Mac were owned by the government, and they said you have to now qualify with verifying your income and your assets, and you got to put 20% down. So for many years, 20% down was what was required. It was harder to get capital. It was harder to get a loan. And slowly over time, these foreclosures and short sales were then purchased by new buyers that could afford to make the payments. And over time, those foreclosures and short sales went away, and there was no more inventory of foreclosures and short sales. And you started to see the real estate market recover. And in 2016 was when we got it's when we started to get some wage inflation again. The unemployment rate had gone from 10% down below 5%. And as the amount of available workers versus the amount of available jobs, as that gap started to narrow, in order to get somebody to come on and work, you had to pay them more money, or people were demanding higher pay. And so you started to get wage inflation. And in 2016, wage inflation was about 1.5%. Then 2017 happened. This is the year that we got the first year of Fannie Mae loan limits going up. We had tax reform in 2017. Corporate taxes went from the highest bracket, 38%, down to 21%. A lot of companies had a windfall, and they decided to put a lot of that money back into their employees. And we had wage inflation. Wage inflation went above 4% in 2018. And as a result, the Fed had to raise interest rates 4 times that year. And, we saw rates go from about 3.75 to 5.25 for 2018. It slowed down the market a bit, but we didn't go into a recession. The jobs market was very, very strong. And the Fed actually had to cut interest rates in early 2019. And when they did that, we saw rates come down all of 2019. And right before COVID, rates had gone from 5.25% back down to about 3.75%. Not related to COVID, but in early 2020, that's where rates had gone. Wage inflation was back at 2%. The economy was really doing fantastic. But as you guys can see on this slide, Fannie Mae loan limits from 2017 have continued to go up and up and up and up and up. And what have you seen with home price appreciation? It's gone up and up and up and up. And wage inflation has now finally started to moderate, but is still right now close to about 4%. So again, I wanted to show this slide to give you guys an idea of how the government is really maneuvering our real estate market through their conventional loan limits, and how it really does have a lot to do with home price appreciation and affordability. So how did real estate perform in 2023? Just a few slides on this. So new construction, we delivered about 700,000 homes, less than expected because there's still been such low inventory, even in new construction. It's just, 715,000, I think was the exact number we had for 2023. Not bad, but definitely not enough. And we only sold 4.09 million homes in 2023 for resale. That's existing home sales. That's the lowest reading since 1995. Why? There's been just no inventory. And it's almost like when rates go up, people stay where they're at even more, right? They don't want to sell because the new payment's going to be too high. If they don't need to move, they're sitting on a really low interest rate, and they're just going to kind of wait out the rates. And you've seen that really help home price appreciation, where normally, a high interest rate environment like this, I believe that it would affect values more than it has. But because so many people, the job market was so strong and rates came down so much during COVID and people were able to refinance, they're sitting on a low mortgage payment with a strong jobs market. Just a very interesting time that we're in right now. And again, you can see here on my slides that the high interest rate environment has not really affected home prices. In fact, FHFA, that's every conventional loan, every FHA loan, every VA loan that is done in the United States goes through FHFA. And FHFA gets a copy of those appraisals. And so they're able to get that data to really see a sample size of the entire United States and how the markets are appreciating or declining. And surprisingly enough, home price appreciation, so FHFA is like the most, I think it's the most accurate view of the economy. Case-Shiller, I'll go over here in a second, is it's a little more directed towards specific cities. But again, FHFA is the entire United States. We went up 6.5% from the fourth quarter of 2022 to the fourth quarter of 2023. The Case-Shiller home index, there's a few indexes for Case-Shiller. There's the 10-city metro, there's the 20-city metro. The 20-city metro is a little bit more accurate. It takes into account 20 of the largest cities in the United States. And 6.1% was the annual increase. What's interesting about Case-Shiller, Case-Shiller even takes into account some of our markets that are very manufacturing based. We're a service-based economy. Our economy grows or shrinks based on the amount of services that we consume. 75% of our economy grows off of services, okay? And we do a lot of importing from other countries. 25% of our economy is growing off of manufacturing, so building goods within the United States and putting those back into circulation and selling those products. Case-Shiller has quite a few markets included that are mainly manufacturing-based markets. Those markets don't tend to go up very much, where we saw those markets did surprisingly well in 2023. Another sign of the jobs market really being hot right now. So that was pretty interesting to see Case-Shiller so high. And as a result, conforming loan limits went up 5.5% for 2024, which was pretty in line with home price appreciation. Now, does this mean that every year that the government's going to raise these loan limits? I don't know. I just can tell you that based on the past and based on what we're going through, that it's tending to line up pretty nicely. I think wage inflation also takes a part in this. But again, it's a pretty good sign that as time goes on, if those loan limits keep on going up, it's a good sign for the housing market. And home prices surged in December of 2023. Why? Interest rates came down. They actually came down quite a bit. I'm going to show a few slides here in a minute and do a quick market update for you guys, and I'm going to really break that down. So Fannie Mae increased their loan limits by 5.5% in 2024, and wage inflation averaged 3.8% increase in 2023. Loan limits tend to rise in line with wage inflation. And if you look at it, I just put it right here, 726 in 2023 to 766 500 in 2024. That's a 5.5% increase. Same thing with the high balance loan limits. Okay, so how are we getting creative in this market? You hear about a permanent buy down for your rate, and you hear about a temporary buy down. What's the difference? A temporary buy down, let's talk through a scenario. Let's say that we write an offer on a property. I'm going to give you guys a scenario that just happened. It was up in the Bay Area. We wrote an offer, we got it accepted at $1,550,000. Agent went back last minute. The sellers were super cool, and they're like, hey, my buyers are trying to do a 2-1 buy down so they have a lower payment for the first few years. Will you give them $15,000? Will you give that to them? And they were really cool, and they're like, absolutely. Doesn't always happen like that. And that's why negotiating is so important. And Denisa will tell you, doesn't always happen like that. You got to negotiate. But these sellers were super cool. They gave them the money. Okay. The buyers used the temporary buy down. Their interest rate was actually 6.625, but I'm going to use 7% for this example. The actual rate in this example is 7%. For the first year, the payment is based on 5% interest rate. The second year, it goes to 6%. The third year, it adjusts to 7%. You see the buy down fee, 2%. That's based on the loan amount. So you got to pay 2% of that loan amount, which is about 15 grand, give or take, at closing. That 15,000 goes to the lender. It's held with the lender. Your interest rate is still 7%. But every month when you make a mortgage payment, the first year it's based on 5%. The difference between the buy down payment the first year of 5% and the actual rate of 7%, that difference in monthly payment is just being subsidized from that buy down fee you gave to the lender at closing. What's cool about this is you could buy with the 2-1 buy down. Rates could come down and call it a year and a half as the Fed starts cutting. And you can go and refinance with my rate rebound program to maybe a 5.5, if we're lucky, interest rate. And now any amount that was paid up front to get this buy down, that buy down deposit, any amount that's still left over that's not been used to subsidize the difference between your actual rate and your buy down rate is given back to you through the refinance. You get a refund of that money. You also get rate rebound with me, where we cover most, if not all, of your fees to do a refinance. This is a way we can get creative and get you into a home with a lower introductory payment. When again, we don't know for a fact what's going to happen with interest rates, but we pretty much know at this point the Fed is done raising rates. So whether they are going to take another year to cut rates or 2 years, at some point they're going to be cutting, and we know that rates are going to come down a bit. So this is a great strategy. We use it all the time. And that's an example of a temporary buy down. Before we go to the next slide, I want to quickly talk about a permanent buy down. A permanent buy down is, hey, Reed, what's it going to cost me to get to 6%? Okay, it's going to cost you 15 grand. Okay, I want to hedge myself against the market. I think 6% historically is a great rate. It actually is. It's the average rate for a 30-year mortgage that passed since like 1970. It's been about 6.625% has been the average. Reed, I just want a 6% rate. I'm going to use that money to do a permanent buy down. You buy down the rate through closing with that money, and now you don't ever get any of that money back if you refinance, but you have a 6% mortgage rate. And now you still, in 2 years or 3 years, if rates get down into the fives or low fives or maybe even the high fours again, maybe they'll do it, then you can go and you can still do a refinance. But you've hedged yourself against what if they don't come down. You've also gotten your payment to a level that you're very comfortable with, and you're good to go. And that's another strategy that we can use. Again, it's going to depend heavily on how much money you want to put into the deal or how much money we can get from a seller through a seller credit. So those are the different examples of a temporary buy down and a permanent buy down. All-in-one loan. This is another way that we get creative. If you have for example, if you have a paid off property, you can get a first lien position line of credit tied to your property, and it ties itself to your bank account, to your checking account. As deposits come into your checking account, it goes against any loan balance you have on your all-in-one loan. It allows you to operate like a bank. Chris George, our owner of our company, actually created this loan program about 20 years ago. It's all over the place on the internet. You can Google all-in-one, and you can go on the website and check it out. It's a great product. You could do it with investment properties also. The interest rates are in like the 8% range, so not quite as low as doing a conventional mortgage, but it's an interest-only payment that you have to make. And the idea that it ties itself to your checking account is pretty phenomenal. We have certain clients that are business owners that have big incoming receipts of deposits each month. And so, for example, you have a $500,000 all-in-one balance, and you've got $200,000 a month running through your checking account, right? And then at the end of the month, that money gets used to pay off expenses. Well, for part of the month, that 200 grand that was in there was going against your $500,000 loan balance, reducing your interest, because now you're only paying interest on $300,000, right? While that money is in that checking account. It's a really cool loan. I don't have an all-in-one loan, but again, I definitely would use this loan if I had a paid off property. All my properties have loans on them. So I think it's a great deal. And also, it doesn't have to be a paid off property. I just use that example for today. But again, that's, I think, the way that I think it's the most beneficial. VA financing. So VA, I mean, if you serve our country, you deserve to get the best loan out there. And this really is it. You can go 0 down payment with no mortgage insurance. Okay. When you buy a property on a conventional loan with 3 or 5% down, you're going to get a loan for 95%, for example, of what you're buying. And then you're going to pay monthly mortgage insurance. You can buy out the mortgage insurance. It's expensive to do that, or you can just pay it monthly. So MI is actually, the cost for MI has gone down a lot because of rates going up so much. MI companies that have sharpened their pencil a little bit, which is kind of nice. Also, FHA loans have mortgage insurance. That's another option out there. You can go with minimum down payment to buy a property, but every other type of loan out there will have mortgage insurance if you put less than 20% down. VA does not. There's also no loan limit for VA loans, meaning you can buy, I did a $2.2 million VA loan in Newport Beach a few years ago. Buyer got a 2.25% interest rate with no mortgage insurance. I mean, that's just the best loan of all time. So VA can also be used on a duplex, a triplex, or a 4-unit property. I have multiple deals in my pipeline right now. Buyers are buying in Texas. They're buying through one of our Marshall Reddick approved builders. They're buying a 4-unit property for $1,050,000, putting 0 down payment. So VA financing, their plan is to live in one of the units for the next 2 or 3 years, move out, rent that unit out, free up all that VA eligibility again, and go and buy another property. So it's very, very lucrative VA financing. And so just reach out to me if you have questions about how this loan works. FHA financing. FHA is the next best option after conventional. If you're not a vet, it's the next best option after conventional. If you want to go with a minimum down payment, this is usually for buyers where your middle credit score is below, let's say 680. FHA will be the next best option for you. The max debt to income ratio for both FHA financing and VA tends to be 56.99%. But VA, you can actually get it approved much higher. It's interesting. Sometimes we get a file that has strong compensating factors. They have really good reserves. There's a lot of different factors that can make a loan file stronger. And we've gotten people approved up into the 60% range on a VA loan. But for FHA, it's the highest debt to income ratio outside of VA financing that you can qualify. So you can go to 57%. It requires 3.5% down. And a lot of buyers will use the duplex financing to buy a 2-unit property with 3.5% down. They were doing it a lot more before the conventional 5% down option became available last November. Again, I've been doing this almost 20 years. That was never available. And now you can get a conventional loan with as little as 5% down on a 2, 3, or 4-unit property. Again, the next best option, in my opinion, is FHA if you want to buy a duplex. You can't go 3.5% down on a triplex or fourplex. There's a rent rule that pretty much makes it impossible. And I'm not going to go into how that rule works, but basically you have to have enough income on the units that you're not going to occupy to debt service the property at a certain ratio. It's like 85%. And it's just impossible to find properties that have enough rent to do that on FHA. So I like to say 1 unit or 2 unit is really your only option for FHA if you want to go 3.5% down. Otherwise, that conventional option will be best. Jumbo financing is any loan amount outside of California in a normal market that has 720, where the loan limit for conventional is 766. It's any loan amount above 766, $500 would be a jumbo loan. In Orange County, for example, or Los Angeles County, any loan amount above $1,149,825 is going to be considered a jumbo loan. What does that mean? It just means that it doesn't conform to Fannie Mae, it doesn't conform to Freddie Mac, it's not a VA or an FHA loan. So somebody has to provide liquidity. What happened in March of 2023? We had the bank runs, right? We had Silicon Valley Bank that went under. We had Old Republic. First Republic. These banks completely went under because investors and people that had their deposits there went and took out their deposits out of the bank. The bank became insolvent, ran out of money, and couldn't operate, right? And so, for an example there, most banks have been holding on to their deposits more rigorously than they did before that happened. You used to get the best jumbo loan going to Bank of America or Wells Fargo. Now that's not the case. Jumbo rates are actually above conventional mortgage rates. There's a couple ways to get around that. You can put 40% down. My jumbo rate today is about a 6.375, 6.5%. Okay. Right now, putting 40% down on a jumbo loan. Okay. But if you're going 20% down or 25% down, I mean, you're going to be up in high 6, even low 7s, depending on your credit score. And I have really the best jumbo financing out there. It didn't used to be the case. Jumbo used to be a lot better than conventional. So if your loan's going to be below $1,150,000, generally conventional is actually going to be the best place now in the meantime to get your loan. I think as the Fed starts to cut interest rates over time and their Fed fund rate goes down, then you're going to see bigger banks are going to start owning jumbo again. They're going to start lending a little bit more frivolously, and you're going to start seeing things like having $1 million with the bank's going to get you a better rate. Right now, it doesn't really do it. So pretty interesting. 700 middle FICO score is really what you want to have to get a jumbo loan. Most programs require 12 months reserves. That's actually changed a lot. We have a Goldman Sachs product now that's phenomenal. You can go all the way to a 50% debt to income ratio. You only need 3 months of reserves. What are reserves? How much money is going to be in Reed's bank account after we close? How much money does he have? Okay, you got to have 3 months of the monthly payment for the home that you're buying. That's what reserves are. You only need 3 months now on that product. Most products will still want to see 6 to 12 months of reserves, but that guideline's loosened up a little bit. Debt to income ratio on certain products now in jumbo, you can go as high as 50. Generally, it's 43%. And for some lenders, it's around 45%. So depending on your qualifying guidelines based on your file, we're going to place you into the best jumbo rate that we can based on your file. And again, those debt ratios would be anywhere from 43 to 50% now. Self-employed borrowers, I want to touch just real quick on this. Every loan program I've been talking about today, you can be self-employed for it. Okay, qualifying is just a little bit different. You have to get a year-to-date profit and loss sheet. You got to get a year-to-date right now for 2023, full year profit and loss. How did your business do? Then we're going to get 2 years tax returns before that. And what we're trying to verify is, did you have any declining income? If you did, how much was it? Did you just make a lot of money in 2022 and now it's come back into line with where it was at before COVID? That can be explained. But if your income is just tanked, right, it's gone down a lot, then you're not going to qualify. And that's the reason why we asked for a full year P&L unless you have your 2023 tax returns done, and then a current year-to-date P&L. You need one all the way through the month that you close in. So a little bit more documentation needed to get a self-employment loan, but the rates are no different. And so again, all these loan products work if you're self-employed. And then ARM financing, quickly touch on that. Adjustable rate mortgages, okay? Because the short-term T-note, treasury note right now for a 2-year or a 3-year or a 5-year or a 7-year is actually paying a higher yield than the 10-year. That's called an inverted yield curve. Normally, your yield curve is supposed to be the, okay, what is a T-note real quick? When the government needs money, they issue their debt into the market in the form of T-notes. Okay, you can buy that debt. Other foreign central banks do it. Big investment companies do it. You can even buy them personally if you want to. Okay, but when we need money, we go issue our debt the same way that a company issues corporate bonds. Okay, and when that money goes into the economy, if the government is only basically borrowing money from you for 2 years, they're supposed to pay a lower yield on that. You're supposed to get a lower return. 5 years, okay, I'm giving you my money a little bit longer, government, so I want more, I want a higher yield, I want a higher rate on my money. Oh, I'm going to give it to you for 7 years, I want a higher rate. 10 years, I'm going to keep my money, I'm going to buy a 10-year T-note, I better get a higher return than a 2-year. What's happened is because the inflation outlook for the next 2 years, since this inflation story started in 2022, because that outlook in the next 2 years has been so high for inflation, the 2-year debt, nobody wants to hold on to that. So there's been less buyers of it. So the yield is higher. And that's what's called an inverted yield curve. The shorter term debt is paying a higher yield than the longer term debt. As the Fed begins to cut interest rates eventually, you're going to see the inflation outlook for the next 2 years is going to come down. And you're going to see a steepening of the yield curve. We're going to go back to a natural yield curve, okay? And hopefully we continue to avoid a recession. This has been a man-made inverted yield curve. That's why we're not in a recession right now. We have a very strong jobs market. We're trying to slow down growth, okay? We're not trying to create it speculatively. That's what's caused many recessions in the past, which is what's caused an inverted yield curve. Again, over time, we'll go back to a normal yield curve, okay? So what's affecting ARM loans? Most of these loans are tied to T-notes. What's the short-term T-notes doing? And as a result, you're not getting a better deal on a 2-5, maybe a 7-year. You might be getting a little bit better than a 30-year mortgage today. But overall, you're not getting a big premium getting an ARM loan versus just doing a 30-year fixed, okay? So again, we really look at 30-year fixed, especially for jumbo right now, is the best product, or maybe a 10-6 ARM, so fixed for 10 years, might have a better rate than a 30-year. And then again, that also factors in down payment. How much down payment are you going to put? Down payment will have a lot to do with your loan pricing, especially on a jumbo loan. This is always a good slide. I like to put this in here. This is when I was working at American Direct Mortgage, first mortgage company I ever worked at. This is at a Marshall Reddick seminar. I started in logistics, setting up all the seminars when I was going to college at 19. I was fascinated by Marshall Reddick. I wanted to get involved. And I got a job as the director of marketing with one of the 5 lenders at the time. We had 5 lenders back then. And the woman's name was Mary Fraze that owned the company. And I got a real estate license and went up to her and asked her for a job, and she said yes. And so I went from setting up the events to going on stage and teaching about loan products. So awesome opportunity that I was given, and I love what I do. And that's a picture of me when I wasn't even 20 years old right there. So always cool to see that. Okay, down payment requirements for investment property. Believe it or not, you can actually go as little as 15% down and get a conventional mortgage. The rates on 15% down are very high. We would advise 20% down as a minimum. And really, if you go on the Marshall Reddick website, most of our properties are defaulting to 30% down right now. We take a conservative approach because we know what has happened in the past with real estate if you bought speculatively. So we're very big on putting enough money down to get at least the rents to cover at least the fixed expenses, the principal interest on your loan, property tax, insurance, management fees, any HOA fees. Those are your fixed expenses. So you want to at least get enough income coming in off that property after those expenses to debt service the property. Okay. So again, you'll see most of our properties are 25 to 30% down on the website. Again, you can go with less down. The minimum down payment for a 2 to 4 unit when you're buying as investment, remember I said 5% down for primary home. For investment, it's 25% down. There are a couple other options out there now where you can go 20% down on a duplex, triplex or fourplex, but you're going to have a much higher interest rate. So private money has really moved into that field the last year. But again, 25% down is the norm, especially if you're going to get a conventional loan. And that's if you buy 1 to 4 properties. So 4 financed properties over time, you can do those minimum downs. When you're buying your 7th through 10th finance property, okay, you have to put at least 20% down on a 1 unit. You can still go 25% down on 2 to 4. But your FICO score, your middle score, we go off the middle score between all 3. TransUnion, Experian, and Equifax, we go off of the middle score, whatever one is the median. It's got to be a 720 or you will not be able to continue getting financing. Your 5th, 6th property, it's a 700 mid FICO score that's required. I should have that on here. But yeah, anyways, that's why I tried telling you guys earlier how FICO scores and credit is so important to maintain and keep that credit good to continue building this portfolio to get to 10 finance or however many that you want to get to. What do you need to know to get to 10 finance properties? Again, must have a middle FICO score of 720. You got to have 6 months of reserves for each property. So 6 months of principal, interest, tax, and insurance. You have to have that in a checking or savings or money market or Marshall Reddick mortgage fund. That would count as reserves. Stocks, right? So you got to have 6 months for each property that you own, including the one that you're buying. The max debt to income ratio goes from 49.99 down to 45 once you're buying your 7th property. So they also, as you get to the end of your 10 properties, why am I saying 10? Conventional will only lend up to 10 finance properties. After that, you have to seek private financing, okay, which there's some good options for that. But the cream of the crop is those first 10. And so again, as you get your 7th, 8th, 9th, and 10th, then they want to see that you're making more income versus your debt. And then it's on 1 to 4 unit properties only. So this is not available for commercial. And just a couple other notes, you can have multiple loans attached to these 10 finance properties. You can have a first and a second loan if you want to do a HELOC on an investment property or on a primary residence. It's about the number of the amount of properties that have loans on them, not how many loans you have on each property. And you can do this on a purchase or refinance, and it's generally only 15 or 30-year fixed loans that are available. And I already covered this earlier. Just again, can you use projected rental income on a property that you're buying to offset your income from debt to income ratio? Yes, you can. You take 75% of whatever the projected rental income is going to be. When we get an appraisal done on your investment purchase, we get a form is included in there called the Form 442. It's a rental comparable analysis. It'll take 4 or 5 other properties like the one that you're buying within a 2-mile radius, what they're rented for, and then the appraiser will average that out. We then take 75% of that amount and add it onto your income towards qualifying. So that's how that works. So if you can't qualify for conventional financing, if you go on marshallreddick.com, click on the borrow tab, you'll see private financing options. They have their rates listed there with their actual rate sheets with all their programs. It's awesome. If you're looking at doing a renovation loan, they're the best in the business. I mean, I don't know of anybody that has as competitive of interest rates with as fast a turn times and accuracy as Marshall Reddick. So definitely check them out. If you're looking to buy a property, renovate it, and then get permanent financing, we can go in and refinance and pay off that loan for you and give you a new traditional 30-year fixed mortgage when the property is complete. We do that all the time with Marshall Reddick. So they also have great bridge loan options. And again, just go on the website if you're curious about their loan programs and check it out. If you want to be introduced to one of our private lending partners at Marshall Reddick, reach out to Denisa, reach out to me. I work very closely with them. I can get you with Stephanie or Aaron right away. Okay. We're going to get into the last segment. I'm going to do a market update. We're going to talk a little bit about interest rates, how they affect cash flow. I'm really going to try to paint a picture here for you guys on what's been going on in the economy from a rate standpoint and really where they're heading. So why are rates so important? Again, this slide gives you a good idea here. Every 1% increase in interest rate affects your cash flow by 12%. So that's why we care about interest rates. When you're on the Marshall Reddick calculator on the website, you can play with it. You can go 6.75 and go down to the bottom of the Marshall Reddick calculator. And it's tied to every property. It's a fascinating calculator. If you're not using it, you should go on and check it out and be using it every time you analyze a property. You can go to the bottom of the page and see what's my return on investment going to look like. If you change that rate to 4.75, you're going to see how dramatically that your cap rate, that your return on investment go up. Okay, so that's why we care about interest rates. That is why it matters. I think rates below 7 make sense if it's a good market, no matter what. You start going over 7 or going to the 8s, you start to get a lot of sticker shock. It's really hard to make a property make sense unless your plan is to refinance out of that loan soon in the future. If it's a construction loan, if it's a loan that's a shorter term loan, obviously the rates are going to be much higher. But for a long-term 30-year fixed buy and hold style property, you want to try and get these rates down below 7%. And again, it really does affect your cash flow. Then on the next slide, so where are rates currently? Where are they sitting? Currently, rates are at 6.88% today. This is a screenshot. This is through Freddie Mac. It shows the national average 30-year fixed mortgage rate from all the way back in like the late 60s. I'm not going to spend too much time on this slide. I do just want to point out, though, do you see that massive spike in interest rates in the early 80s? Okay. Paul Volcker, who was our Fed chief at the time, currently we have Jerome Powell. Paul Volcker had to push the federal fund rate to over 20% to slow down hyperinflation. Okay. Our Fed fund rate today is 5.5%. So to give you an idea, he had to push it all the way to over 21% is about as high as it went. My dad was buying homes back then, and he said interest rates were about 18% for a 30-year fix. You could put your money into a money market account at Bank of America and get a 10% return. So totally different market. That market was caused due to an oil shortage that we had that was around the world. We had reached max capacity. We couldn't pump any more oil fast enough to keep up with demand back at that time. And then you had the Yom Kippur War where OPEC shut off all their oil reserves to the rest of the world, okay? And that caused hyperinflation. Oil prices went to over $100 a barrel, And oil filters into everything. It's in everything that it's almost even in your food, but it's in everything, even vitamins, right? The machines that make the vitamins require oil to run the machines. Nowadays, we have other alternative energy sources, so we're not as dependent on oil as we were back then. Back then, everything ran off oil. If the cost of oil is going up dramatically, the cost of goods and everything in the economy goes up rapidly. And we had hyperinflation. And to slow down the economy, the Fed chief had to raise rates to over 20%. Why I point this out, we just had something happen with COVID that is, I hate using the word unique and COVID in the same sentence because unique kind of has a positive tone to it. COVID was not positive whatsoever. But we'll use the word unique because I can't figure out another word that works better than unique. COVID was just extremely unique. It's never happened. And it's, again, when you look at this line chart, you see how rapidly the Fed had to raise interest rates, similar to how fast they had to raise them back then. We had to take our federal fund rate from 0 to 5.5% in under 2 years to slow down inflation. And as you can see, we've kind of hit a peak here. It was last year when rates hit 8%, and inflation has been sticky, but it is slowly coming down, and we can see it in the charts. So what is happening with inflation? Consumer price inflation was 0.2% in November. It was 0.2% in December. And then moving into the new year, we have a little bit of inflation resurgence. That's what the Fed's afraid about right now. Annual core inflation right now, so the core number, you strip out food and energy, what's the prices for rents, prices for goods, or rather for services, certain types of services. That core inflation rate is 3.8%. Wages are included in that too, in that reading. It's down though from 5.6% in December of 2022. CPI, so consumer price inflation, this takes into account food and energy, is at 3.2%, down from 9.2% in June of 2022. So we've made a lot of progress on inflation so far, but the Fed wants to see wage inflation and, more than anything, consumer price inflation and core inflation down towards 2%. That's what they want to see. That's why they've raised interest rates like they have. And as you guys can see here, we're still not there. We're not even at a true Fed pivot yet, where the Fed's like, we're for sure raising rates around this time. They've said that they're going to do it this year, but we don't even have a month pegged out yet. And that's because of this inflation resurgence. January and February, it's picking up again. They don't want to see that. So I'm going to dig into the next slide. I'm going to go through exactly what I look at every single day. This is a screenshot for the Fannie Mae 6% mortgage coupon. This is the most closely traded mortgage-backed security in relation to the conventional mortgages I talked to you today about. When a loan for $400,000 and one for $600,000 and one for $200,000, when these loans are originated and funded with the bank, they're slotted together into a pool of mortgages and they're sold in the secondary market. They may be sold to Fannie Mae and Freddie Mac. They may be sold to a large institution or a hedge fund. They may be sold to another foreign central bank. Different central banks buy our debt because it's been fully underwritten and it's essentially underwritten off of those conventional guidelines, and it pays 6%. Remember I told you about T-notes. The 10-year T-note today will only pay you about 4.15%. So now the U.S. never defaults on their debt. That's a safer asset than buying this asset, but this is the next best thing. So those loans are pulled together and they're sold in the secondary market. Green, each one of these little candlesticks is 1 day of trading, Monday through Friday. It trades the same days as the stock market. On a day you have a lot of green, there's more buying than selling. The buying causes the bond to appreciate, which drives down the yield. Okay, it makes rates better. Red, investors are selling the bond, causing it to depreciate, which drives up the yield, makes rates worse. So when this goes down, rates are going up. The first highlight, that's when interest rates hit 7% in 2022. That really slowed down the boat. You saw it in the data because in November, when we got October data, it showed inflation had peaked. CPI inflation went down to 0.1. okay? And the market loved it and it cheered, and that's why we had a great day for mortgage rates that day. Then as we got through the end of the year, rates got significantly better moving into 2023. And the market thought maybe the Fed is done hiking interest rates. But what's that third highlight? That's when we got January preliminary inflation data. It showed inflation shot back up and we had extreme inflation resurgence. Why did we have that? Because companies had the power to raise their prices. Different service providers had the ability to raise their prices. They were able to do it because the consumer was healthy, stronger than anybody thought. The jobs market was still very, very strong. There was a lot of COVID cash still built up, okay, that was circulating into the economy. People were spending money. As a result, inflation picked up. We had inflation resurgence. And as you guys can see there, the best rates we had of 2023 were in the beginning of the year. Then we worsened quite a bit. Then if you go a little bit in here to like the beginning of March, you'll see rates started to improve again. That's back when we had those bank failures, okay? And the market started to believe that maybe there's some bigger issues going on underneath the curtain right now or behind the curtain. And as a result, rates need to improve and the Fed should stop hiking. Well, soon enough, we realized inflation was really sticky. The jobs market, we're not in a recession, and wage inflation and CPI inflation, all these forms of inflation continued to go up throughout the year. The Fed stopped hiking interest rates, but it was sticky and they didn't necessarily go up. They just didn't go down, right? It's not going down to 2%. It's still going up at a rate of 3% plus, and it was too sticky. So the fourth highlight is in October of 2023. This is when mortgage rates hit over 8%. And I mean for every product out there, it was over 8%. Now, before that in September, what caused that to happen? And I'm almost to the end of this, guys, where I'm going to tie this all together for you. In September, before the September Fed meeting, the Fed said in 2024, our federal fund rate can be 4.6%, currently 5.25 to 5.5. That had told the markets when we get through 2023, eventually the Fed's going to be cutting rates at least 3 or even 4 times in 2024. Well, in the September meeting, they did not raise the federal fund rate anymore. They said it's definitely high enough. But what they did do is they raised their projection for how high the federal fund rate needs to be in 2024 to slow down inflation. They raised it from 4.6 to 5.1. Meaning maybe not even hiking at all, or even maybe one time. And so higher for longer. They also raised their 2025 projection from 3.4 on the federal fund rate to 3.9% higher for longer. As a result, interest rates went to over 8%. Now, do you see the same theme though here? You come out of summer, you have the strongest spending. The Fed's got to slow down inflation, so they scare the heck out of the market to slow down the boat. As a result, in October, everything really slowed down. We got that data in November, and look what happened. Interest rates improved dramatically into the end of the year. Now, the fifth highlight here, the fifth one, second to last, right there is when the Fed came out and they said, okay, guys, inflation's cooled back down more again, and we're going to take the projection for 2024 on our federal fund rate. We're going to take it back from 5.1 back down to 4.6. And the same thing for 2025, 3.9 back down to 3.4. When they did that, they basically pump faked the market, okay? When they did that, interest rates hit the best levels that they've hit. There's one more important, significant thing I've not talked about yet that is the most important thing on this slide. These different lines are your moving averages, okay? The purple line, the one that's the highest on the top there, is your 200-day moving average. The pink is the 100-day, the dark blue is the 50, the light green and the blue is your 25 and your 10-day moving average. If you guys notice, we have not traded above that 200-day moving average and stayed above it even one time since the Fed started raising interest rates in the beginning of 2022. We've never been able to close above it. We've tried to touch it. You saw it back when we had the bank failures. We almost went to it there, right? Back in like April. We tried to touch at the beginning of 2023, and then inflation resurgence rejected that level. But now you can see we're finally trading above it. Why? The direction of the flow of money has changed. We know now, okay, we're getting closer. It's not yet, but we're getting closer. And why I bring this up is the minute that interest rates start to actually go down significantly, and we're still in a good jobs market. Unemployment went up to 3.9 from 3.7 this last month. It's ticking up a little bit, but it's still extremely good jobs market. As rates start to actually come back down, people can afford to buy with minimum down payment. That, oh, I couldn't buy at a 6.5%, 7% or 7.25% rate, but I can buy at a 5.5% rate, and I want a tax deduction. I want to deduct the interest on my mortgage payment against my income because I'm buying as a primary residence. I want home ownership, right? I don't want to rent anymore. There's going to be more buyers. What happens when you have more buyers? You already have pretty tight demand. We might have more sellers because people now can sell and get a better rate when they buy somewhere. But by and large, you're going to have more buyers than sellers. And you're probably going to see prices creep back up more. Okay. So I'm bringing this to your guys' attention. We're now trading above our 200-day moving average. Now, the beginning of the year, we had some inflation resurgence. I covered that on a prior slide. January, it went back up to 0.3. Last month, February, it went up to 0.4. That was market expectations, though. They expected we were going to have some inflation resurgence. It's not out of control. If inflation resurgence in March looks as high as it did or higher than February, man, we're not going to be cutting interest rates till after summer. Right now, Fed futures are pricing in about a 40% chance that the Fed is going to cut interest rates by June. It was 60% yesterday before we had CPI this morning. Now it's dropped down to 40. And there was a 100% probability that they were going to cut rates by July. After today, I haven't looked at it yet, but it's probably at 60 or 70% because the Fed needs to now see a longer period of proof that inflation is easing. They're going to want to see multiple months. We're not seeing that yet. In fact, it's just going up again. So again, a lot can still happen here, but we do have less money in the economy for spending right now than we had at the beginning of 2023. We can see that because we can see how much revolving credit do consumers have and how much savings do they have. The savings have been getting depleted. The revolving credit has been going up. So we know inflation resurgence will likely not be as hot as it was the beginning of 23. But the longer that it continues to stay where it's at or go a little higher, the further out these Fed rate cuts are going to be. So if you're expecting rates to be 5.5 this year, maybe if we get lucky because it just tanks at some point, inflation throughout the year, we will get that by the end of the year. But I would argue you're going to be 6.25 to 7.25 somewhere in there for the whole year. This is the year to get prepared. This is the year to get a great deal still, if you can get one. This is the great deal to identify an area that you want to be in, that when rates were 2.875 in 2021, you were getting outbid because everybody was just placing crazy offers. Austin, Texas, great market to look at right now. Okay, the values have come down and normalized quite a bit there. So anyways, and then where we're at today is that current highlight. We actually have sold off from that. Today, we're now going down here, testing our 200-day moving average because we had, the inflation report today was a little bit hotter than expected, but not out of control. So again, just real quick here on this slide, the Fed's growth target is 2%. Currently, we're sitting at 3.8%, down from 5.7, but we're still a ways off from 2%. One thing I'll note is as we get closer to the election, I think they're just going to stop caring about inflation altogether. I think by the time that we get to September, they're going to force rates down. That's what I believe. But you know what? I could be off, right? Like nobody knows for a fact. But this is an election year. And if you get rates coming down, it's going to help out the lower to lower middle class. And that's going to create more optimism. It's generally why they tend to do that. And it's going to help our current administration to try and stay in office. This is what happens pretty much every single time that there's a president, or rather there's a presidential election coming. So again, I just don't think until then, if inflation resurgence stays like it's been, I don't think they're coming down much at all. And I still think that you're not going to go down below 6.25 this year. I just don't see the need for that. I think that's probably going to be your low side of what you're going to see with a normal down payment. Maybe putting a huge down payment, perfect credit, you'll get a 599 again without points, but highly doubtful. Highly doubtful. They just need to go down into the mid to low sixes again without points, maybe even a little bit lower than that. And then one more thing I want to note is inflation caused by oil prices. None of that can be controlled right now. The Fed doesn't have any control over that with their policy rates. I do know that if we start to drill more in the United States, though, and we start to produce more oil, that's probably going to ease some forms of inflation. Like I talked about earlier, oil filters into everything, and the prices being at $80 a barrel right now, they were 46 before COVID, okay? They're 80 bucks. They need to come down. We need those to come down. That will help inflation. This is just a slide that does show that 30-year fixed mortgage rates do follow inflation. That what I'm talking about is it's been proven in the past that it's factual. And so at some point they will come down. And that's why we say get a great deal today and refinance when the rates make sense. And if rates do come back down dramatically or even partially over time, you will see home prices tick up unless the jobs market falls apart. But you guys, 3 million people retired during COVID, 3 million. There's a lot of high paying jobs available. We still have 8.8 million jobs available. That's the JOLTS report, the Job Opening and Labor Turnover Survey. It shows we have 8.8 million jobs available with a 3.9% unemployment rate. That means there's a lot of options still to get a job out there. So again, I think that you'll continue to see opportunity in the United States, even if the unemployment rate goes up a little bit more from here. This slide, I don't want to get too deep into the weeds right now. Pretty much just kind of what I just covered. You've still got 8.8 million unfilled skilled labor jobs. The unemployment rate is almost the exact same as before COVID, but we have 7.5 million jobs before COVID available. Now we have 8.8 million with basically the same unemployment rate. That's what's causing more wage inflation than needed. Example, if you're at Google and you're a team lead and you're trying to get some new programmers for your project and you can't find them out in the community, you got to go to Facebook or do a different tech company like Oracle or Apple, right? And try to get them to come on board. How do you do that? You pay them more money, right? So if there's more available jobs and less people to work them, that causes wage inflation. And before COVID, we were at about a 2% wage inflation and we had 7.5 million unfilled skilled labor jobs. So we need to get closer to that number. There's some other factors included in this, like work from home. Some of these numbers that you see too with the BLS and that are online about jobs, who knows how factual that they really are. But by and large, this data is pretty dependable. And again, we still have way more jobs available than before COVID. And until that number comes back down, you're going to still see high wage inflation. So we want some wage inflation. We just don't want it to be 4%. We want it to be 2.5%, 2%. And at some point, as you guys can see here, the Fed fund rate before COVID was 2 to 2.25. Currently, it's 5.25 to 5.5. And we have almost the same jobs market. It's a little bit hotter. So at some point, the Fed should be able to bring interest rates down on their federal fund rate without destroying the economy and getting the amount of available jobs more in line so we have stable wage inflation. That was just another slide. This is the last slide that I want to show. This is where we were at in 9/21 of 2023. This is before interest rates went to 8%. When we were looking at this slide back then, it was a little scarier because we didn't have that washout of 8% mortgage rates. That has now happened, and I am pretty sure that we're not going to have to go back that high again. Hopefully, again, we really don't know until we get further through the year and until we see how is inflation resurgence picking up or going down, and is it subsiding going into summer. Again, this is a great year of opportunity to find a good deal. Use the high interest rates to negotiate a better deal or get into an area that you couldn't get into during COVID, and you can do a refinance in the future with our rate rebound program. It's very important that you get a good deal right now. The most important thing. My weekly update goes out every Saturday. If any of you guys want to be added on that, just send me an email, let me know. Yeah, and I would love to send that out to all you guys. It goes out every Saturday. It's just more sample size data. It's not as in depth as what I went through today. But yeah, that goes out every Saturday. That's my presentation tonight. It's been great talking to you guys. I hope everyone is well and got something out of tonight, learned something. Please do contact me anytime. Me and my production assistant, Brian, and my loan officer, David, are going to be reaching out to everybody that was on the call just to say hello. That's David Self. And we'll reach out and say hi to you guys, send you an email, give you guys a phone call. If you're looking to buy or refinance or just want to talk about what's going on out there, talk about interest rates, look at a specific scenario, just take our call, take our email. We'd love to work with you. And Denisa is going to finish us out here and talk about a consultation that we offer.
Thank you so much, Reed. That was awesome. I hope you guys got a lot out of it from our financing wizard, because he's still saying it's a great time to buy. Take advantage of those deals that you can get out there before the market starts going crazy again, which is what we might see as we get closer to that election. So thank you so much, Reed. I just want to point out that we have this property rating ebook. It's for free. You can get it on marshallreddick.com. The ebook will talk about investments in general and how they are classified and how to help you choose the best investments, best market, etc. Also, reach out to us because like I mentioned, we have a free data market packages. We have the awesome mortgage calculator. We will go over, when you reach out to me as your advisor, I'm going to go over the why, how, when, what, where, who. We'll talk about obviously your potential achievements and where you want to get to. So please, again, my name's Denisa. Feel free to reach out to me. This is my contact information. Like Reed said, we are going to follow up with you guys. Thank you for being here tonight. We really appreciate your time, and we wish you well. Thank you so much.
Thank you.